Family, what's up? Welcome to another Food and Finance Fridays here on Law's Legacy. I want to take some time today just to break down term life insurance. Now, life insurance period can be confusing for people, but really the basics are pretty simple. And so I want to make things a little simpler, a little easier for people. So I'm going to give just a general overview of term life insurance period, what it is in essence. And then also I want to break down some specifics, okay? Before I do that, I have here, got some, I feel a little bit like, Shirley Caesar. I got, some, rice, beans, potato, you know. So, but yeah, it really is. It's got a few different types of rice in here. Have some beans, kidney beans, black beans. Um, there is some lettuce, broccoli, potatoes, and something called polenta. It reminds me of grits, but it's different. Okay. There's also some mushrooms in here. So like a lot of good stuff is really packed. So let's go ahead and taste it. Mmm. 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 I'm gonna taste some curry seasoning. Excuse me, there's some curry seasoning on here. Also cauliflower in here. I forgot to say about that. I mean, so it's just packed with a lot of good stuff. Hmm. That's really good. I like to continue eating this. I'm gonna get to talking about this term insurance. Hmm. Mm. That is really good. Oh man. So, like I said, I'm gonna go over overview pretty much of term insurance across the board. What it is, what it does. But again, what is insurance? Okay, insurance is the transference of risk. So it's transferring from little old me, little old you, to this company. There's some windows here. By the way, I did not get an A in art class. So that's what's going on here. So it's transferring the risk from person to this company. All right. So with life insurance, the risk that's being transferred is the risk of death. Sure enough, folks go die. Been doing a whole lot of it. Okay. So, but there are two types of life insurance. Okay. There's temporary, or which is also called term, and then there is permanent. Go down here. Then leave myself enough room. Okay. So those are the two basic types of life insurance. Okay. We've dealt with permanent in the past. I'm gonna break down term a little bit. Remember, it's temporary, so it is if you die. It's like renting a house, apartment, car, whatever. It's renting, right? So I'm renting. When I stop paying, I don't have it. I don't get anything at the end of it. All right, I haven't used it up. Right, it has a term of years. Okay, so with term life insurance, you can have anywhere from 5 years, as little as 5 years. Some companies you can have up to 40 years. All right, not all companies, but that's pretty much in a nutshell what it is. Okay, you have a set number of years that you are covered. That if you die within these number of years, then your beneficiaries who you set to receive money upon your death receives the death benefit. It's that simple. Okay? Now, how there is a cost you do have to pay for it, of course, um, and that is called your premium. All right, that is your payment. Okay, generally it is monthly. It can be quarterly. It can be annually. All right, but most times people pay it I said premiumly. People pay it monthly, and that's pretty much what the insurance company expects of most people. Okay, so now, what does your premium cover? Your premium covers in term insurance. It just covers your death benefit. That is the cost of insurance. Okay, death benefit and cost of insurance. There's little fees for this and that. All right, but the biggest part of what is covered is this death benefit. And this is what goes to your family, your loved ones, or could leave it to a charity. Okay, this is the parent, little kids. All right. So there's that. All right. Now, what makes up the cost? Okay. So there are a few things that make up the cost. All right. For one, your age, how old you are. The younger you are, the less expensive it's going to be. The older you are, the more expensive it's going to be. So you want to get it when you're younger. Also, your health. And you guessed it, the healthier you are, the less expensive it's going to be. The more unhealthy you are, the more expensive it's going to be. And there will come a point where you're too old and too unhealthy to get life insurance. So when's the best time to get life insurance? When you're young and healthy. All right, so those two things make it up. Also, your lifestyle. So if you are here living real wild and reckless, and remember the risk that the insurance company is taking on is that the risk that you're going to die. So if you are doing things that makes it more likely for you to die, the cost of insurance is going to go way up. In this case, the more boring you are, the less you're going to pay. Okay? All right. But then there's those three, but also the length of the term. That looks like a fancy V. Okay? The length of the term. So like I said, you can get anywhere from 5 years of coverage to some companies have 40 years. Most times you get like 30, but there are some companies that have 40 years, a 40-year term. So if you have 5 years or 40 years, what you go pay more for? Go pay for the 40 years. More years of coverage, the more expensive it's going to be. shorter the term, less expensive it's going to be. So those are the things that make up the cost. All right. Like I said, there are also some cost of insurance. There's little fees that go to the company, but most of it is covering for you. All right. So, pardon me. So those are things. Those the overview of no matter what the company is. Those are going to be some factors that you can expect. Now to get into some more specific things. All right. Now, all life insurance companies they have term insurance. It's going to be a term. In the longer the term, more expensive. Shorter term, less expensive. All right. They're going to have a death benefit. They're all going to have that. But then there are companies that have something that's called living benefits. Okay. They have living benefits. All right. So what are these living benefits? Okay. The most common for those companies that have it, they have what's called critical ill. Well, let me not start with that one. Let's go from the most severe down to the least. So first there's terminal illness, okay? Now what is terminal illness? So what a terminal illness would be considered is something that is very detrimental to your life, to your health. It could be like cancer, stroke, things like that. A heart attack. Okay, those are a few examples that it's very serious, but it's not necessarily going to kill you. All right. No, I'm sorry. That's critical illness. Terminal illness. I'm sorry. Terminal illness means they're saying you're gonna die in less than a year. Please forgive me. So terminal illness is saying that you're gonna die in less than a year. The doctors are expecting this to kill you for sure. All right. So and it could be cancer. It could be stage 4 cancer. It could be congestive heart failure. Different things like that. They're like, this person, because this illness is so severe, we do not expect them to live. All right, it's like less than a year. Okay. Then there is critical illness. Okay. And it is what I was describing before. If I can spell, that would help. So ILLNESS. That's what that is. All right. Critical illness. Well, I was describing before. It's very detrimental to your health, but they're not expecting it to kill you. All right. And they're expecting it, not to continue on for a long time. That they're thinking they're gonna be able to, handle it, deal with it, and reverse cure. Like cancer, we know can go into remission. They can do surgery and be like, okay, this is serious. We caught it in time. So we think you're gonna make it. All right. Like I said, it can be a stroke, something like that. All right. Then there is chronic illness. Okay. That's N. All right. Looks crazy, but it's N. This is an R. Got it? All right. So chronic illness. That's something that they're expecting to continue for a significant period of time. All All right. So they expected longer than 3 months, 3 months or longer. They're expecting you're going to need additional help. Okay. So what triggers a chronic illness case is when you are not able to complete without significant help 2 out of 6 activities of daily living. So it can be from transferring, which is walking, eating, bathing, toileting, continence, and there's a sixth one that, for whatever reason, right now, it's left me. But if you cannot complete 2 out of those 6, um, then it triggers a chronic illness situation episode. And so now, not all life insurance companies have these, but those that do, what are these things called? They are called riders. Okay? Okay, and what are riders? Riders is something that it attaches to the policy and rides along. Okay? In movies, sometimes you can see someone skateboarding or rollerblading, roller skating. And they grab onto a car, and they would attach themselves to a car. And they would just ride along. So they're using the car's force momentum, to pull themselves. And so that's what a rider does. Okay. Now, with these riders, when they are triggered, when you have terminal illness, terminal illness, critical illness, or a chronic illness, what happens is they will advance a percentage of the death benefit. Okay, now it's just going down. It says death benefit. Now, when it's advancing a percentage of the death benefit, it varies from company to company. All right, there's some companies that will advance up to 90% of the death benefit. So what that means is they will pay it out to you, so that you can deal with these different matters. If you need to use the money for additional treatment, especially like with a chronic illness, and where you're needing additional help, like my father, before he died, he had to have what was called long-term care. So chronic illness, it can be used as long-term care. Okay, where he needed additional help, he actually ended up needing around-the-clock help. Where for a while, we were able to deal with it in home. Eventually, he had to go into a nursing home. So, chronic illness rider can help to protect me in something like that. All right. So they will advance a portion of the money. Now you may need some of the money to handle bills. Maybe you don't need that additional help around the house as much, or maybe a family member can help. Maybe it's not something you have to pay for, but maybe you need help paying the bills because you're not able to work. And so that having that money advance can really come in handy. All right. Now there's one other cool thing that I want to talk about. That once again, not all companies have this, but it is a very, game changing type of benefit and can become absolutely necessary. And I'll explain that. Okay. When a term insurance is convertible, convertibles are cool. I think, no matter what you're talking about, when it can convert into another thing. So, what is a convertible term policy? So, think of like a car, okay? You can be rolling around in a drop top, right? But it starts raining. Oh, you're gonna need to put that top up, okay? So you go from having no top, having that drop top, right, to having the top up. You have a roof, okay? So the drop top, you like that turn, but the top up, when you need that extra protection, that's the permanent. I'm just gonna put perm, okay, from term to perm. Go leave it down there for now. All right, so what I said, when this can become absolutely necessary, all right. So the cool thing about it is that for a number of years, however long you have it, you get whether it's 5, 10, 15, 20, 30, or 40 years, okay, a 40-year term, within that time period, for the companies that have this, you could turn that temporary policy into a permanent policy, which means now you can have it for the rest of your life. Where this can become absolutely necessary is if within the time that you have the term policy, you become uninsurable for whatever reason. Maybe you had a diagnosis of shucks, trying to think of something like okay, stage 4 cancer, or some type of mental or brain illness, like Alzheimer's, dementia, something where that now it's going to be kind of hard to get life insurance, okay? So what you're able to do is you're able to lock in the same rating that you had when you got the policy. So let's say you got it when you're young and healthy. I just wrote a policy for a gentleman. It's a 20-year policy. He's 35 years old, right? And at first, I was just going to write $250,000. And we ran the numbers. It's like, okay, it's going to cost you about $30. $30 a month for $250,000 of coverage, right? For 20 years. He's like, okay, cool. That sounded pretty good to him. Well, went through what's called underwriting when they looked at his age, his health, his lifestyle, as well as the length of the term. And they came back, it was going to be about half of that. So we talked to him like, listen, they told you that it can come back, they can accept it, that they can reject it, or they can have a counter offer. And usually people are thinking that, they might charge me a little bit more. Well, I'm like, hey, they're actually charging you less. You can choose to take it, as it is, or because you are already expected to pay $30, we can see if you can get more coverage. Well, he got $500,000, right? And it was still less than $30. It's $27. So now he's 35 and young, healthy, and everything. And it's a policy that has living benefits, and it is convertible. So he could choose to lock in that great rating that he got and turn it into a permanent policy. And he's guaranteed to be accepted for them to turn it into a permanent policy. Only thing that they're going to look at now is how old is he? Is he older? Okay, then they're going to adjust the price for this permanent policy, which is going to be more expensive anyhow, because again I said that they look at the term, they look at the length of the term. The longer the term, the more expensive it's going to be. So now we're going to turn it to a permanent policy that's going to be for the rest of his life. They're expecting him to live a long time. Okay? But again, because he's healthy, it's still going to be really, really reasonable. All right? The actual cost may even still be under, for $500,000, probably not, but still could end up possibly being under $100. More than likely be a little bit over, but still for $500,000 of coverage for your life, and when there are living benefits, it would be really cool. So, though, that's definitely something that you might want to look at. If you have interest in something like that, I highly recommend that you speak with a financial professional. Of course, I make myself available. You can reach me by email at loudslegacy22@gmail.com or by phone at 330-319-0141. It'll be that information will be in the description. All right. Hey, I hope that you found this information useful and helpful. If so, go ahead, click that like button, subscribe. Please subscribe to the channel. That helps the channel grow, helps this information get out to more people. Share it, which also helps it get out to more people. Share it with someone who could really benefit from this. Leave a comment and make sure you hit that notification bell so you'll be notified every time and anytime that I upload a new video. Hey family, again, hope that's helpful. Be blessed, and remember to take control of your time, your money, and your future. God bless. I'm out. I hope that video turned off. Nope.